But for me, the key macro theme is how we see the next Republican administration influencing the global economy. Because at first look, you have a set of policies that are very much America first. This is an administration that wants to spend more. They want to cut taxes and they want to see stronger growth in the US. And they're looking to fund some of that stronger growth via raising tariffs around other parts of the world, particularly China, where you've heard President elect Trump talking about the potential for a 60% tariff on Chinese goods entering the US economy. So at face value, this looks like it's positive for the US economy. And we saw similar back in 2016, where tax cuts did give a boost to the US growth outlook and to the earnings of US companies. But I think this strategy now comes with two key risks. The first is that when demanding all of this extra funding from the bond market, bond investors become worried about the level of debt, the level of deficits, and start to push US borrowing costs higher. The second is how domestic businesses in the US respond to increased trade tension. Because we saw back in President Trump's first term, when tariffs were implemented, particularly against China, that led to a slowdown in business confidence, a slowdown in business investment, which weighed on the economy overall. So we called our 2025 outlook pushing the boundaries. The idea here is that the next Republican administration will push how much they can spend, will push how strongly they can see the US economy growing, but could also be pushing up against some limits when it comes to inflation, given that this combination of tax cuts and tariffs could indeed create new price pressures next year.
We're constantly looking at market sentiment, whether it's countries or industries or sectors or asset classes, fixed income versus equities or commodities. So right now, if you think about Trump getting elected, I think that was 2 weeks ago when we're recording this. There's a massive amount of flux. People don't know what's going on. Last night, Trump announced not just tariffs, increased tariffs on China, but also Mexico and Canada. So the peso's down, the Canadian dollar's down. We'll look at that and say, is that realistic or not? Is long term, is this a great value for buying the Canadian dollar or the Mexican peso? We'll also continue to look at China, where, that fears around China and what Trump's going to do to China have been well telegraphed, and they are resident in the valuations of the Chinese stocks. So we've actually been buying those a little bit recently because American tech stocks are selling at 40, 50 times earnings, and Chinese tech stocks that are really, really well managed are selling at 7, 8 times earnings. Is China really that bad? Is Trump going to really hammer them? Or, as a contrarian might say, maybe Trump is going to go in there and want to win, want to deal with G, and we could have, massive returns in those names for taking very low risk.
The two things that are key, I think, to mention here. Firstly, the starting point is very different. When I look at how markets have reacted to the Republican victory, it feels very much like 2016. You have smaller companies outperforming, you have the US market generally outperforming other regions of the world. And when you look sector by sector, some of the potential beneficiaries of less regulation, for example, are really starting to perform strongly. However, when you think about the valuation today in US stock markets, it's in a very, very different place to the starting point of President Trump's first term. Back in 2016, you had the S&P 500, the most popular US stock market benchmark, trading on about 17 times forward earnings. Today, that market is a lot more expensive. The valuation is around 22 times forward earnings. So it's not clear to me that the US equity market can see the same kind of benefit from more fiscal stimulus as it did back in 2016 and 2017. The second point, I think, is to be really wary about focusing too much on the politics and not recognizing the broader economic backdrop. One example of this is if you look at the performance of energy sectors under President Trump's first term and then under the Biden administration. Because everyone went into 2016 assuming that this would be a very positive environment for traditional energy stocks, and it would be a very difficult one for clean energy and renewable energy. And then under Biden, you'd think the opposite would be true, with the Democrats more supportive stance for some renewable initiatives. But when you look at the way that those two sectors fared, actually under Trump's first term, you had incredibly strong performance for clean energy when you had the traditional energy sector underperforming, and then vice versa. So broadly, bear in mind the US market is in a very different place today to where it stood at the start of President Trump's first term. And second, be wary about extrapolating politics and not taking into account the broader economic environment when it comes to relative performance under the sun.
So we spend a lot of time considering the risks that we see in the markets and try to ameliorate some of that risk so that we can create a moderate risk profile on the funds. And when we look at risks, they really haven't changed since the election. It's still, we're very worried about inflation. The market got worried about inflation and has subsequently decided that it's not a big deal. But if you look at the long-term structural drivers, they're still all there. And despite the fact that Elon Musk is talking about how they're going to cut costs on the government, that's really just chipping around the edges. And his boss is talking about tax cuts. So it's we're still very worried about inflation. We are worried about government budgets, not to get too macro, but that has sent us towards having very little exposure to global government bonds. We continue to have overweights in on the bond side in Treasury inflation protected securities and gold. And then where we are in equities is focused on companies and industries where where they're in a super cycle. So it won't really matter whether won't matter whether we're in a recession, whether we're in expansion, as the market seems to perceive the US will be in. But things like semiconductors, critical energy infrastructure, and defense have themes that are much bigger and broader than a short-term economic cycle.